Welcome to Earnings Central. In this video, we'll break down Citigroup Incorporated's second quarter fiscal 2025 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. All right, let's go. Starting with top-line revenue, the original estimate for Q2 was $21.00 billion. The company actually reported revenue of $21.67 billion, surpassing expectations by 3.2%. This quarterly revenue also marked a 7.6% increase compared to the $20.14 billion reported in the same quarter last year. Moving to adjusted earnings per share, the original estimate for Q2 was $1.66. The company actually reported an EPS of $1.96, exceeding expectations by 18.1%. This result also reflects a significant 28.9% increase compared to the $1.52 per share reported in the same quarter last year. Now, let's dive into some additional performance metrics highlighted during the earnings call. Citigroup delivered an 8.7% return on tangible common equity this quarter, showing the bank's ability to generate solid returns for shareholders. This isn't just a one-off performance either. It represents consistent execution across all business lines with positive operating leverage in each segment. The bank's capital position remains rock solid at 13.5% common equity Tier 1 ratio. This is a full 140 basis points above regulatory requirements, giving Citi tremendous flexibility. What's particularly impressive is how they're using this capital strength strategically, not just hoarding cash. Speaking of capital deployment, Citi announced $4 billion in share buybacks for the current quarter, demonstrating management's confidence in the business trajectory. They've already repurchased $3.75 billion year-to-date as part of their massive $20 billion buyback program. This aggressive capital return shows they're not just talking about shareholder value, they're delivering it. The crown jewel of Citi's franchise continues to be their services business, which delivered a stunning 23% ROTCE. This high-returning business saw revenues grow 8% with robust growth in both loans and deposits. The underlying fee drivers like cross-border activity and U.S. dollar clearing are showing real strength, positioning this business as Citi's most valuable asset. Markets had their best second quarter since 2020, with revenues jumping 16%. Fixed income was particularly strong, up 20%, driven by increased client activity in rates and currencies. Equities had their best Q2 ever, with prime balances hitting record levels. This performance shows Citi's trading platform investments are paying off. Finally, cost of credit came in at $2.9 billion, which is actually quite manageable given the current economic environment. Most importantly, they're seeing improvement in card credit trends, with delinquency rates moving in the right direction and loss rates within expected ranges. Now, let's shift focus to some of the key insights and takeaways from the earnings call. CEO Jane Fraser made it crystal clear that their 10% to 11% ROTCE target for next year is just a waypoint, not the destination. This signals management's confidence that they can drive returns significantly higher over time through three key levers: revenue growth, expense discipline, and efficient capital deployment. One of the most encouraging developments is that transformation costs will start decreasing next year. After spending $3 billion last year on transformation efforts, management expects this investment to decline as programs reach target state and deliver sustainable results. This cost reduction will be a significant tailwind for profitability. Citi is making serious moves in digital asset strategy, and this isn't just buzzword bingo. Their Citi Token Services platform is now live in 4 major markets and has processed billions in transactions. They're exploring stablecoin reserve management, tokenized deposits, and custodial solutions. This positions them at the forefront of the next evolution in cross-border payments and liquidity management. What's particularly impressive is that all 5 business lines delivered positive operating leverage this quarter. This doesn't happen by accident. It demonstrates disciplined expense management while investing for growth. Services, markets, banking, wealth, and U.S. personal banking all grew revenues faster than expenses. Despite macro uncertainty and geopolitical tensions, client activity remains remarkably strong. Cross-border transaction values were up 9% year-over-year. U.S. dollar clearing volumes rose 6%, and they onboard nearly 2,000 new suppliers in their trade business. Clients are clearly leaning on Citi's global platform to navigate uncertainty. Perhaps most importantly for the consumer business, credit quality is improving in their card portfolios. Both delinquency rates and net credit loss rates are trending in the right direction following pre-COVID seasonal patterns. This gives management confidence in their credit loss guidance and supports the overall consumer strategy. That wraps up our recap of Citigroup Incorporated's second quarter fiscal 2025 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way from Earnings Central.